Hi guys, this is Stephen from Share Navigator, and I just want to flag a trade that we're looking at now on Citigroup. So you may have seen the trade alert go out in the Stock Investor Club. If you haven't seen it, go and look at it. We've done our fundamental research. We like Citigroup, and we're now looking at on the options trading side of things, actually buying a leap on the stock, and we're looking at buying the $50 call option. And we're also looking, secondly, to reduce the cost of that call option is to sell monthly cover calls against it. So I'm going to talk you through the strategy in detail here. So just a brief overview on Citigroup. The current price is 51.73, and that was at the close of business on August the 27th. So this was something that was on our radar for a while, guys. We were hoping for a pullback in the market first before we took a position in Citigroup. But given the comments from the Federal Reserve last night and the fact that they're going to let inflation run through 2% for a period of time if it does get up there. Now, just bear in mind, guys, they haven't been able to do that in 10 years, get inflation above 2%. So the fact that they've changed their language last night does not mean that inflation is actually going to get above 2%. But let's assume that it does. What they're saying last night is we're not necessarily going to raise interest rates in that environment, and we're actually going to let it inflation run a bit higher. Now, what will that will do to the yield curve? It will actually steepen it, and eventually they'll have to come in and start raising rates, which will be very good for financial institutions. And that's why banks who've been totally unloved during this recovery may start getting a bid now. You may see funds starting to pile up into it, and I can already see in pre-market there that Citigroup is up 1% already, and it's very early days in pre-market. Now there may be opportunities later on after a sell-off. This news, may cause a bit of buying today, and we may sell off then maybe next week sometime. Who knows? But I just wanted to give you the heads up as to the rationale in Citigroup. So anyway, it's trading at 51.73 as of last night. The dividend yield is 4%, which is substantial. And that's enough for me to own the stock and kind of reduce my risk. And we've a 12 to 18 month target price of $70 on it. So it's trading at a discount to its peers at the moment. And based on historical norms and forecasted earnings for next year, we think it could go as high as $70. And if um, inflation starts to rise, guys, I think you could see banks do even better than that. So I do think, this is an environment where inflation is very muted. But if inflation does start to take up, I think the banks could do really well. Um, so I'm just looking at if we bought 100 shares, and I'm going to compare it against actually buying a call option instead. So if we bought 100 shares, the investment amount would be $5,173. Our break-even price is what we paid for it, 5172, or 5173, whatever the case may be. So our potential profit is our target price minus what we've paid for it, which is 18.27. So return on investment when you throw in the dividend there could be around 39-40%. So the pros of that, of course, are the dividend, and if we do hit our target price, we could do quite well, 39% return on investment. The downside is if we're wrong and let's say inflation doesn't go anywhere, markets hate banks and the stock starts falling, we've invested a large sum of money in there, and obviously that's going to start reducing as the share price falls. So, is there a less risky way of participating in this? And that's really what we're trying to share with you now. So, we're going to look at the January 22 call option. So, out in 500 days, we're looking at. Um, and we're looking at paying 921 for the $50 call option. So remember, you've over 500 days now for the stock price to rise. So if we bought one contract on this, the cost will be $921. So remember, one contract is 100 shares of stock. Our break even is 59.21, and our potential profit per share is $70 minus the 59.21 investment, which is 10.79. But our return on investment, guys, here is much higher. It's 117%. So the pros of doing the long call option, remember what a call option allows you to do. It allows you to buy 100 shares of stock, in this case at $50 between now and January 2022. So if the shares rally up to $70, we're able to get in there, buy the stock at 50 and sell it at 70 immediately. So the benefit of doing that is we don't have as much of a capital outlay. So the next slide really will show you. If you think about it with our long stock, that's anything that's kind of negative I've highlighted in red. we've outlaid $5,173, whereas buying the call option, we've only outlaid $921. That's the maximum we can lose. Our break-even price is much better though on the long stock because a call option involves time value. You can see that we're talking about at expiry. So if we get to January 2022, the share price needs to be above 59.21. Now, between now and then, there'll always be time value in that call option. So it doesn't have to get above that price, let's say next month. So if next month, if the shares rise $1 or $2, our call option will actually be in profit most likely. Um, so it's only at expiry. I want to stress that. Our profit potential per share is obviously higher in the long stock on a per share basis, but don't forget we didn't put out as much money with the call. And that's why our return on investment is much higher here at 117%, whereas the return on investment on our long stock is only 39%. So the pros are with a long stock, you get the dividend. When you buy a call option, you don't get the dividend. And actually, the dividend can work against you because usually the stock comes down by the amount of dividends that are paid out. And that will impact the price of your call option. Cons, the long stock, the investment amount is substantially greater. It's a larger chunk of your portfolio. But then again, the call option there is a higher break-even price and you don't get a dividend. So there's pros and cons to both strategies. So for smaller accounts, obviously the long call looks more attractive. But if you have a large account and you don't fancy managing the trade and you just want to sit and buy and hold, well then the long stock might be a better option for you. But no matter what way you slice and dice this, guys, there's less risk involved in buying the call option because there's a smaller outlay. So what you can do with both positions as well, folks, is to reduce the risk, is to sell call options against it monthly. In other words, sell covered calls. So when you sell a covered call, all you're doing is giving somebody else the right to buy your stock from you at some date in the future. So looking out a month from now, for example, out to September, we could sell the $55 call and take in 74 cents a share. So on our call option, that would reduce the cost of that, if you think about it, by 74 cents. So our new break even in that situation would be 59.21 minus the 74 cents we've taken in for the September call option, and that would give us a new break even of 58.47. Now this is at expiry January 2022. So there's two potential outcomes here, guys. Let's say we get to the expiry in September of our short call, our covered call, and if the share price is below $55, well then basically the covered call will expire worthless, will disappear. We keep our 74 cents a share. We've reduced our break even on our long call option. And then we get to go and do that trade again into October. We could pick a higher strike price depending on where the share price of Citigroup is, whatever we choose to do. So we're free to go at it again then, basically. But if the share price finishes above $55 in September, you're going to have to take some sort of action because your cover call is now going to be in the money. And if you don't do anything, you're going to be short 100 shares of Citigroup, but you'll still own this long call, this $50 call. So what you really do there in theory is actually just sell your $50 call option and close out your short stock position. And you would be doing that for a profit because the value of your $50 call obviously will have gone up in value because the share price has risen. And that will offset any of the losses on your $55 short call, and you should have a net profit depending on where the share price is. So that's the way you could manage this trade, and that's what we intend doing on a monthly basis. We actually intend selling calls against our long call position. So just a couple of things to consider when you're doing this. If the shares rise substantially, then we can adjust our cover call strike. So let's say, for example, here the shares get to $54 by September, our covered call expires worthless, and now we're trying to decide what strike price do we pick to sell a call for October. Well, we could up it maybe to $57 or $58 for October, for example. We don't have to stick with the $55 short call. You could apply this to the stock as well. So, we're applying this to our leap to try and reduce the cost and the risk in that leap, but you could do that on the stock side as well and reduce the cost of the stock. And there's no right or wrong way to do this. Every investor is different. So as I said, some people prefer investing in long stock, and that's absolutely fine. There's nothing wrong with that. Those of you who may have more time to manage the position will see the obvious benefits of less capital outlay for a higher return on investment. And then the fact that you can eat into the cost of the trade every month as well and reduce the cost of your leap substantially. So, for example, that 74 cents, it eats into our $921 investment quite substantially. $74 off that is quite substantial, whereas $74 off a $5,000 investment isn't as substantial. So if you think about it, if we did that over 12 months, we're practically reducing the cost of our long call to zero. And that's the plan with this, what we call a poor man's covered call. So I hope that explains it to you guys. Please ask as many questions on the forum here as you deem necessary. It is a very good opportunity in our view. If it's wrong, we can manage that by reducing that risk with those covered calls. Okay, this is Stephen from Share Navigator with a trade update on Citigroup. When we place that trade, we will let you know exactly what we have done and how we're going to manage it. Okay, thanks and bye for now.